Episode of the Meet Kevin Show. Today, Peter Schiff is coming back. I believe this is now the fourth time that Peter has taken the time to join us here and share his perspectives. Peter's information and funds are linked in the description down below. But boy, oh boy, do I have questions for Peter Schiff now, because I'll tell you, the last three times Peter Schiff has been here, I've always been the bull. And Peter's had, kind of put me in check a little bit. I'm like, hey, we're going to the moon. Peter's put me in check a little bit. Now I've turned a little bit more bearish myself. Okay, y'all know I've sold some stocks, sold lots of stocks, selling a little bit of real estate. Now I want to talk to Peter because macroeconomic climates are changing a little bit here, and it's time to talk to Peter to see what he thinks now that we've got some serious headwinds. So welcome aboard, Peter. Thank you so much for being back.
Kevin, my pleasure. Thanks for inviting me back. And I'm not bearish on everything. I'm bearish on certain things. The motto of my firm, and I think Jim Cramer over at CNBC actually stole this from me, but my motto was Euro Pacific Capital, because there's a bull market somewhere. And, there may not be a bull market here. And, I adopted that theme during the earlier part of the 2000s, after the NASDAQ bubble popped, 2001, 2002, we were in a bear market for years, and I was trying to encourage my clients, hey, it may be a bear market here, but they got bull markets in other countries. And now, pretty much 20 years later, we're seeing the same dynamic unfold. I think we're at the beginning of a massive long-term bear market in U.S. stocks in general, in specifically the stocks that did the best over the last decade. The momentum stocks, the big tech, the FANG names, anything related to, these SPACs, all these recent IPOs, payments, cryptocurrencies, or all these crazy kind of companies that don't make any money. Last year, we actually set a record, not only in IPOs, but IPOs of money-losing companies. These companies are going to crash and burn just like the dot-coms did, but from beneath the ashes of those collapsing companies, you're going to see a lot of other stocks rise. And those are the stocks that I own. The same types of stocks that did really well from 2001 through 2008 and then into 2011. Those are the types of stocks that investors are just starting to buy now. Global value, dividend payers, commodities, emerging markets, precious metals. These are where the bull markets are, and this is where investors should be allocating their money.
Now, Ray Dalio, or at least Bridgewater Capital, so Ray Dalio's firm that he co-founded, recently released an investor letter and indicated that right now in the U.S., you've got stock valuations still relatively high, and you've got monetary and fiscal tightening, whereas in China, you have relatively low valuations and fiscal and monetary support. And so they're making this argument that, maybe, like you just mentioned, maybe U.S. stocks isn't the place to be. Their argument is China. What's your take on China?
Well, I'm bullish on China, but there are a lot of other countries that I'm also bullish on. It's not just a choice between the United States and China. It's a big world out there. But the United States is very expensive. Even our legitimate companies, the ones that actually do have earnings and pay dividends, they're generally twice as expensive as a similarly situated company in Europe or Asia. So you get much better valuations, and investors are going to be more focused on valuation now. That's one of the reasons that a lot of these stocks, like look at Facebook, they came up with bad earnings, the stock drops 25% in one day. Same thing with a PayPal. Because the valuations are so high, if you just miss expectations by a small amount, you're going to get completely clobbered in this market where we're starting to revalue stocks at lower multiples because we're no longer in this low inflation environment. We're in a high inflation environment, and what people still don't understand is that this high inflation environment is here to stay because there's absolutely nothing the Fed is capable of doing about it. In fact, everything the Fed does is going to throw gasoline on the inflation fire. So Fed monetary policy is going to exacerbate the inflation that we're dealing with. Even though they're talking about fighting inflation, they're not really going to fight it. They're going to keep stoking the flames, just they're going to be less aggressive. What they're talking about doing is raising interest rates from 0, where they are now, up to maybe 1% by the end of this year, and maybe up to 2% by the end of next year. But these are still highly stimulative rates of interest. It was in 2002 that the Fed slashed rates to 1% to stimulate the economy after, the NASDAQ bubble burst, and after, we had the terrorist attacks in 9/11, and we started, the war on terror, and all that stuff happened. We had a recession, and so Greenspan lowered rates to 1 to stimulate the economy. Now Powell's saying, well, we're going to raise rates to 1 to sedate the economy. I mean, it's still low, and the Fed is still printing money. And the problem is the budget deficits have exploded. We're talking about maybe $3 trillion a year now is what our annual budget deficit is. The only way to finance that is for the Fed to do more QE. So even though it's talking about shrinking the balance sheet, it's not really going to happen. The balance sheet is going to keep expanding. But not only do we have this huge budget deficit, we have record trade deficits. Last year, we had the first ever merchandise trade deficit to exceed $1 trillion in a single year. And in the month of December, we hit a new record high. We had over a $100 billion deficit in December. And these deficits are going to skyrocket. Look at the price of oil, now $92, $93 a barrel, heading well above $100 a barrel this year. We're at net importing a lot of oil. That further runs up the trade deficit. So there's no way to finance this. The Fed is going to be forced to print even more money. So while it's pretending it's going to take the punch bowl away, it's going to continue to spike it, but it's not going to be enough to sustain the asset bubble. So the change in monetary policy is a significant enough shift to prick the bubble in tech stocks and momentum stocks, but it's not big enough to slow down inflation. So we're going to have stagflation. We're going to have a weakening economy, rising inflation, and that is a very different investment landscape than the one investors have been used to over the past 10, 20 years.
Yeah, so the thing about inflation, and I want to ask you about this, is, if prices of, let's say, the Apple Pencil go from $100 to $110, we got 10% inflation. Do you believe that companies have the pricing power to keep raising these prices to where that pencil goes to $115, $120, $125, and it actually just continues to go up? Is this not potentially just a one-time set of, that's it, the Apple Pencil went from 100 to 110, we had our 10% for a year, and now we go back to, the 1, 2, 3%. Do you think that 1 to 2% interest is still so accommodative that we're actually going to still see 7+% prints on CPI?
Yeah, well, because the cost of making those pencils is going to keep going up, maybe 10% a year, maybe more. So the manufacturers are going to have to pass on those higher costs to their customers because they have to operate at a profit. So at a minimum, they have to pass on the costs. But what they end up doing is actually passing on more than the cost, because you have to find a new equilibrium. Because every time the company raises prices, it does lose some buyers on the margin, because we're all sensitive to price. I mean, if we weren't sensitive, the companies would just jack the prices even higher. The reason that there's a lid on prices is because companies are looking for the optimal price where they can sell the most amount of stuff and make the most amount of money. And so as you raise prices, you start losing some of your customers. So there's a sweet spot where you can have the maximum amount of profit. Well, that all changes when your costs go up. So when their costs go up, they have to find a new equilibrium where they can maximize their profits. But what happens is as you start raising your prices, you start losing some customers. And so now you have fewer customers to try to average out all your fixed costs. So the new equilibrium price where you can maximize your profits ends up being even higher than just the increase of costs, because you have to make up for the loss of customers. So what happens in an inflationary environment is businesses keep selling fewer and fewer products at higher and higher prices, and those customers that can afford the higher prices keep buying, and those that can't, well, they go without the products.
Yeah, that's actually really interesting because and it's something I haven't thought about, and I've read a lot of the earnings calls over the last couple weeks here in earnings season, and every single company talks about how much pricing power they have and how the consumer's willing to pay these higher prices and that they're all raising prices. I mean, Panda Express, Starbucks, GM, Ford, they're all raising prices. We know this. but what's fascinating about what you just said is when they raise prices, they're going to lose customers. So if they want to be able to beat revenues next year, or next quarter, they actually have to raise prices a little bit more beyond just the margin expectation because they want to offset the loss of customers. That's fascinating. I hadn't thought about that. Almost like the self-fulfilling
And here's
inflation.
the thing. Last year, though, businesses didn't raise prices enough. That was the problem because you had the Fed chairman and all the economists were telling everybody, oh, don't worry about these rising costs. This is all transitory, right?
Yeah.
And so the business owners believed the economists, and so they absorbed these price hikes in their own costs because they didn't want to just raise their prices if it was just a one-off thing. If it was just higher costs for a few months, they probably figured, you know what, we'll just eat that. It's not worth raising prices, losing out to our competitors, annoying our customers. We'll just ride it out because it's temporary. But as we got to the end of the year, and now these companies look back, we just got the earnings on Friday for Clorox, and Clorox got killed down 10%, 52-week low. Why did it get beat up? Well, they missed. Why'd they miss? Because their costs were up a lot, and obviously they didn't raise their prices nearly enough to cover the increase in costs. And so I think a lot of these businesses that were kind of conned into this false sense of complacency on what was happening, now they have a lot of catching up to do. Not only do they have to get ahead of the curve for 2022 and start factoring in rising costs for 2022, but they got to catch up for all the lost ground from 2021. So they have to raise prices a lot. And that's one of the reasons I've been saying that rather than 2022, CPI number coming down from the 7% we got last year, 2022 is probably going to be higher. We're going to go maybe from 7% to 10%.
Oh, yeah. People are going to freak out. If they freaked out at 7%, people are going to freak at 10%. So what I want to know is when then do you think, because at some point consumers are going to stop paying these increased and elevated prices. What is that point? Is it when the consumers are out of money? When does that point come? Or do wages just rise to give people more ammo?
Well, first of all, wages are rising. The problem is they're not rising as much as prices, so people are running out of ammo. Yeah. But some people are not buying stuff. Look what's happened recently to car sales. I mean, car prices have gone way up, and so car sales are coming down. I mean, people are buying fewer cars. It's happened in the real estate market. I mean, the prices went way up, and so fewer people can afford to buy them. So they're still trading, but not as many people can afford to buy. Now, certain things like food, I mean, people are going to keep spending money on food, but they change, what they buy, right? They don't buy as much steak. They buy more, hamburger, right? So they're not eating as well as they would like to because they can't afford some of the stuff that they used to be able to afford. They have to trade down, and it's going to happen across the board. People are going to buy cheaper stuff or less things. And it's probably already happening. It's just going to happen more as the inflation gets worse.
In this case, would it make sense to buy companies that provide these, the economical term, inferior goods, like maybe more Walmart stock, more Dollar General style stock?
Yeah, well, Walmart, again, would not be, number one on my list because Walmart's a pretty expensive stock as it is. And I think the volume of sales is going to dry up. I mean, they sell a lot of more expensive things that have higher margins that I think will impact their sales. But you're right. You want to skew your portfolio to stuff that people have to buy, not stuff that they buy because they want to, right? So people have to buy certain products, right? And so you've got much more pricing power if the consumer has to buy what you're selling versus a discretionary item that, if he has any money left over, he'll buy that. But first he has to take care of what he needs before he can start buying, what he wants. And so, and if you look at a lot of the stocks that we own for our customers, those are the companies. A lot of these consumer companies or utilities, you got to pay your electric bill. You don't want to be in the dark. I mean, you can use less electricity. You can, watch how many lights you leave on. You can adjust your thermostat, but you're going to buy electricity no matter what. You're not going to, live in the dark, and use candles. So these companies are still going to sell energy, right? Your gasoline. People are still going to drive cars. They may not drive as often, but they're still going to drive. Maybe they're not going to take a long vacation, or maybe they'll carpool, but you're still going to buy gas. So these oil companies are still going to make money. We have a lot of tobacco stocks. I mean, people are going to smoke. I mean, they may not even cut down on their smoking. They might have to cut back on their eating, some people, before they cut back on their smoking. Wow. But you buy these things that people are going to keep buying, and you can raise your prices. Your costs go up, you raise your prices, and you can stay ahead, and you can pay dividends. And absolutely, you have to be in companies that have a lot of pricing power. Now, there are a lot of these companies that have products that's highly competitive. Like, look at all these streaming stocks. I mean, one of the places people can easily cut back is just look how many streaming services are you going to buy, right? Maybe you look back and I've got 6 or 7 of them. Yeah. You're going to cut back on 3 or 4 of them, or maybe I'm going to take a streaming service and I'm going to use it for a week or 2. I'm going to watch what I want to watch. Then I'm going to unsubscribe from that one. And I'll have one at a time until I, watch the shows I want to watch. But, people are competing for the same, group of customers, and these customers are dealing with higher food prices, higher gas prices, higher rent. So they got to cut back where they can cut back, And I think too, a lot of these companies that give away their products, right, like the Facebooks, right, you don't pay money to have a Facebook account. But the problem is Facebook makes money from the advertisers. And if the advertisers aren't selling as much of their stuff because the people on Facebook can't afford to buy it, well, now the advertisers can't afford to advertise on Facebook anymore. Right. So Facebook's earnings go away, even though they're giving away their product. The fact that their customers don't have the discretionary income, their real product, which is the advertising, they can't sell that. So there's a lot of these businesses that are going to be in a lot of trouble when everybody is tightening their belts.
So when folks start tightening their belts in an environment where we have high inflation, obviously this brings up fears of stagflation, which you have mentioned. I believe, and I want to hear your opinion on this, I think there's quite a big risk that we could end up having a negative quarter or 2 of GDP, which that puts us into a technical recession or paper recession. Is anything safe going into a recession other than cash?
Well, cash isn't safe either. I mean, the problem is there's nothing that's truly safe. Everything has a certain degree of risk associated with it. And so what you have to do as an investor is decide which risks you want to take, right? What are you comfortable with, and what risks do you want to avoid? Because cash is not safe. If you have inflation at 7%, and of course, when the government admits it's 7%, it's 15%. Because the government lies. The numbers are cooked, right? The way they measure it. If we still measured inflation today, the way we measured it during the 1970s and 80s, last year would have been 15%. So it's just a big lie. So if it's 15% now, and I think it's going to be 10% next year, that means it's 20% this year, right? So you have this massive inflation. Cash is losing value every single year. You don't get any interest in the bank to offset that. You put your money in the bank, you're making no interest, and it's losing 7, 10, 15, 20% of its purchasing power every year. That's a big loss. So there's no safety there. You can't buy bonds. Bonds aren't safe at all. What's the coupon on a bond? What's the interest? 1%, 2%, 3%? You're still getting killed there. But the problem with bonds is, let's say you buy a 10-year bond or a 20-year bond, and you're getting 2 or 3% interest on that bond, and then interest rates really go up, the price of that bond crashes. So if you need to sell the bond because you need the money, you're not going to get par. You might take a 20, 30, 40% loss on your bond. The only way you get your money back is if you hold it to maturity. But if maturity isn't for another 10 or 20 years and inflation is 10% a year, by the time you get your money back, it's not worth anything. So there's a lot of risk in bonds. That's why you have to go into real things, real assets. What I mentioned at the beginning of what the podcast is, dividend paying value stocks around the world, stocks that are trading at like 8, 9, 10, 12, 14, 15 times earnings. Stocks that pay 4, 5, 6, 7, 8% dividends. Now, companies that are making money, paying dividends that you can own, the value of these businesses will rise with inflation. The value of their goods that they own, the value of their inventory, the value of their plant and equipment. If they own resources, those will become more valuable. They can raise their prices. So you have a hedge against inflation when you're in a stock, and the dividend can go up. The bond coupon is fixed. Whatever interest coupon you're getting, you're stuck with that, no matter how high prices go. But your dividend can go up if you're owning a company that pays dividends, and you need earnings to pay dividends. But a lot of these other companies that don't have any earnings, they're going to have a lot of trouble staying in business, because a lot of American companies have been able to stay in business because their real business is selling stock. They sell stock to investors, and then they use that money to pay their expenses, to pay salaries. Those days are coming to an end. A lot of people in America are going to get unemployed, which is one of the reasons that we're going to have this stagflation, inflation, and recession, because as a lot of these money-losing companies go out of business, all their employees are going to be out of work.
Yeah. Is it not possible that, because we've seen commodities go through these cycles before? Is it not possible that commodities just end up bubbling up and then crashing back down, or do you just have to adjust when that time comes?
Yeah, that is possible, but I think that's not going to happen for a long time. I think they will bubble up at the end of the bull market. The problem is, this is just the beginning. Think about the oil market. Oil topped out at $150 a barrel in the last bull market, and it topped out in 2008. It was the summer, July of 2008. The Fed funds rate was 6.25 at that time. That's how high 6.25. It's a quarter right now. It's 25 basis points. All right, look how much room we have to raise interest rates before we get to a point where oil might peak out. And also, the dollar index in the summer of 2007 was about 73. It's 95 now. So we had a much weaker dollar back then. We have almost $100 oil now with a strong dollar. So if you figure we're starting a cycle where the dollar is going to start falling and interest rates are going to start rising, how high will interest rates get, and how long will it take to get there, and how low will the dollar be before oil peaks again? I think you could be looking at a $300 oil price before you get another big drop. And so that's basically a triple from where we are now. Maybe it happens over the next several years, but if we got to $150 a barrel in 2008, why couldn't we get to 300 by 2028? Right, it's 20 years, and you get a doubling in the oil price over 20 years from peak to peak. Can easily happen. But if that happens, you're not going to be able to get gas for less than $10 a gallon at a gas station. So now, what is that going to mean to the average American if it costs you $10 just to get a gallon of gas?
We've never had a recession, or we've never been over $100 in a barrel in oil without a recession. So I think there's probably the answer, huh?
Yeah, and also, we've never started a recession when the Fed was starting to raise rates. The recession may be starting right now. The Atlanta Fed, their estimate for Q1 GDP is 0.1%. So it can very easily be a negative number. But the Fed is just starting to raise rates. In fact, they haven't even raised them yet. They're just talking about raising them. And the economy is already going into recession. See, normally the economy doesn't go into a recession until the Fed has already raised rates a lot. Normally the recession starts when interest rates are a positive number, a real number, meaning you have to get the rate of interest above the rate of inflation before we roll over to recession. Well, if the inflation rate is 7, we need to get interest rates at 8 or 9. Well, we're not even anywhere close. So this is going to be the first time we're going to go into a recession where we have negative real interest rates. We're in a lot of trouble, because how does the Fed normally fight recession? It cuts rates. Well, if we're practically at zero and the recession starts, there's not a lot of room to go, right? So we're in a box that the Fed put us in. And I've been warning that this was going to happen for years, because I was able to understand the consequences of what the Fed was doing. Every time they kicked the can down the road because they didn't want to deal with the problem, they made the problem worse. And now the problem is so big that there's no more road and we can't kick the can because we've got this 7% inflation albatross around our necks, because the only way they've been able to justify these 0% interest rates in QE was because inflation was below their 2% target. Well, how can you justify the same monetary policy when inflation is more than triple your 2% target?
Oh, no kidding. Why do you think this GDP forecast here is so weak? Because right now, at least in earnings, we're seeing a lot of enthusiasm around earnings and people spending. Everybody seems like they're spending like crazy. I mean, people are buying boats and cars and jets, and everybody's spending money on everything. Why would the Atlanta Fed estimate this low of a GDP? I mean, this was the consensus back in December. I mean, we've gone from a 3.5% print to basically nothing.
Well, first of all, we had a big inventory build in the fourth quarter of last year. That was 71% of Q4 GDP was businesses stocking up on inventory. Now, why did they do that? I think it's because they're going to an inflationary business model. See, before there was a lot of inflation, people didn't keep a lot of inventory. Businesses were lean and mean, just in time. You ordered goods as you sold goods, right? You didn't want to carry a lot of inventory. What was the point? Just buy it in the future, when you needed it. But now, with prices rising so much, businesses want to invest in their inventory. Why wait to buy the products? They're just going to be more expensive. Let me buy them right now. And also another thing that's happening is that supply chains are, broken down and delivery times are extended. And so companies are like, look, let me get this stuff and have it, because that way at least I can sell it, because I don't know if I can get it in the future. So businesses are now moving back towards holding inventory, which is something they used to do. I mean, it was normal for companies to have more inventory. And so now we're getting back to that environment. And so what happened is these businesses just bought a lot of inventory that maybe they would have bought throughout 2022, and they just bought it all at the end of 2021. Yeah. So that means the businesses aren't going to be spending that money in Q1 and Q2 and Q3. So we moved forward a lot of that GDP growth to the fourth quarter of last year. And then also the trade numbers are exploding. These trade deficits are just horrific. They subtract from GDP, right? All these trade deficits reduce our GDP. So if we're going to have much bigger trade deficits, we have to subtract a much larger number from the GDP. And so, I think inflation is taking a toll on spending. I mean, you're talking about people are spending more, but in many cases, they're not buying more. They're just paying more. So they're spending more because the prices have gone up. Because these consumer spending numbers and retail sales, they're not adjusted for inflation. They're just looking at how much we're spending, not what we're buying.
So wouldn't an inventory, so two things about inventory. More inventory to me suggests that we could have deflationary figures, because they might want to lower prices.
Yeah, a lot of people think, the businesses are going to dump this inventory. No, they're not. They didn't load up on it to dump it. They loaded up on it to have it. And what they're going to do is they're going to mark it up and they're going to sell it slowly. And here's how I think businesses are going to price. They're not going to price off of their original cost. They're going to price based on their expected replacement cost. So let's say I'm a company, and I sell widgets, right? Widgets is just a made-up word for a fictitious product, right, from economics. So I sell widgets. So let's say I bought a bunch of widgets at $10 a piece, and I have a 50% markup. So I buy for $10 and I retail them, I sell for $15, right? So I bought a bunch of widgets for $10. But let's say I start selling my widgets at $15. Then all of a sudden, the wholesale price of widgets jumps up to $20. They double from 10 to 20. I'm not going to continue to sell my widgets at $15, even though I bought them at 10, because if I sell it at 15 and now I have to buy one back, I'm going to pay 20, right? So now I'm just going to start selling my widgets for 30, because that's 50% above my replacement cost, which is 20. And so this is how businesses are going to operate. They're going to start marking up based on replacement. They're going to hold their inventory. They're going to sell it slowly. They're not just going to dump it on the market at a low price when it's going to be so expensive to buy it back. So I don't expect this mass liquidation of stuff. I think businesses are buying this stuff because they need it to operate. They want the inventory, and they are making an investment in their inventory.
Yeah, I mean, really suggesting that a built-up inventory is going to lead to plummeting prices is really suggesting that supply chains are perfect again, and we're going back to just-in-time inventory, essentially, right?
Yeah, I mean, and you'd have to make a bet that all these guys that are loading up on inventory, as soon as they get it, they're just going to dump it all. Like, why did they buy all that inventory if they're just going to dump it?
Yes.
And if that was the case, then all these companies would lose a ton of money, right? They would buy all this stuff and then sell it at a loss.
Yeah. That makes sense.
So I don't think that's what's going on. And I think they waited all year, to start buying because, again, they were hoping it was all transitory. They believed the economists. And now, Powell finally comes out and says, okay, it's not transitory.
Schiff.
And now the businesses are like, now you tell me, and now they got to hurry up and start doing something. Because I know, in my life, everything I want to buy, and I'm in Puerto Rico, so it's even worse, but it takes forever to get stuff. I mean, months and months and months. You just have to wait because nobody has anything.
Is it possible that a lot of this extra inventory that we saw in Q4 GDP is in transit? That like you say, it's taking so long to get. Maybe this is not inventory on shelves yet. It's sitting on a ship somewhere, in a container in a warehouse somewhere.
Yeah, that I don't know how much of the inventory spend has actually been delivered. We know there's massive delays and there's bottlenecks at the ports. So yeah, I don't know, but I think they place these big orders, and now they're going to sit on their inventory, and they're going to sell it at higher prices. And of course, as they mark their inventory up, it's not going to move as fast because people are going to be priced out of the market. And what I think a lot of these businesses are going to have to do is downsize their overall operation to be profitable at a smaller scale, right? Because if you're forced to really raise your prices and you're going to have fewer customers, well, you don't need as much customer support. You don't need as much of a overhead, right? If you have a smaller group of customers that are utilizing your business. So everybody has to scale down, and that means layoffs. That means maybe some of my office space or some of my warehouse space or my retail space I don't need as much, and so now there's stuff for rent, and the economy goes into recession as everybody downsizes to survive in a world where you don't sell as much stuff because everything you're selling is more expensive.
Right, exactly. So what do you think then? If we're on this path and companies feel they have so much pricing power, they're raising prices, we're going to see this continued inflation. What do you think the odds of a recession are, and when's this happening?
Well, I think the odds of a recession are 100%, right? I mean, the question is, when does it start, right? Because we're always going to have one, right? So when is the next recession going to come? But I don't really believe the government numbers anyway, because when they lie about inflation, they also lie about inflation in the GDP, because there's something called a deflator. And the government takes the nominal GDP, which is how much prices went up, and then they adjust it by what they claim inflation is. So let's say, nominal GDP, the prices were up 6%, but inflation, they say, was 4%, then they end up with 2% GDP, right? But what if inflation wasn't 4%? What if it was 8%, but they pretended it was 4%? That means that if they used an honest inflation rate, we would have a negative 2%. We would be in contraction. But because they pretend that inflation is only 4% when it's really 8%, it looks like the economy grew by 2%, even though it contracted by 2%. So we're going to get a recession, even the way the government scores it. But of course, it's actually going to be a lot worse than what they admit to. And it may be that the government still pretends the economy is growing, but it will feel like a recession because it is.
Yeah, and how do you, that also begs the question of, like, what happens if we go into a recession and then people look to Jerome Powell to bail us out, and then there's no Jerome Powell U-turn? Do you think they have a capacity to U-turn and help prevent a recession or bail one out?
Well, that's the problem. See, this is the Pandora's, not the Pandora's box, but the catch-22 that the Fed is in, where they're damned if they do and damned if they don't, because their normal policy response to a recession is to stimulate demand, right? Print money, create inflation, bigger deficits, more government spending, tax cuts, right? A Keynesian pump priming stimulus. Well, you can't do that when you have inflation, because the way to fight inflation is the opposite of that. You have to shrink the money supply. You have to curtail demand, right? You have to slow the economy, right? You don't want to pump it up. You want to slow it down. So what happens when you have both of those problems simultaneously? You have a weak economy, recession, but you have inflation, right? It doesn't work anymore.
Yeah.
And that is the problem. And, while I remember this too, I meant to make this point when we were talking about inventories. It just occurred to me. But also, customers, just like businesses are stocking up, so are their customers. I mean, I don't know about you, but I don't buy one of anything. I mean, if I'm going to buy toothpaste, I'm going to buy a dozen tubes. Right? Sure. Deodorant, shampoo, razor blades. I mean, last time I bought razor blades, I bought like 40 of them. And I don't even shave that much because I just, but I didn't know like if I'd be able to get them in the future. I mean, if you go through our house, you will open up a closet. It's like a drugstore. There's so much stuff there. It just goes, I got everything we need. We got all vitamins. We get everything. And then we buy in huge bulk quantities of whatever doesn't, get bad over time, whatever's non-perishable. Batteries. I mean, we've got drawers and drawers of batteries. I mean, so I think a lot of other people are going to do the same thing. They're not just going to buy one thing. Because if you're an average person, right, you're not making an investment, right? You're not, investing in the stock market with me. You're just going to the supermarket, right, with your paycheck. But, let's say you normally shop for the week. And you keep some money in the bank, a little bit of savings. But if you notice that every time you go to the store, stuff is 3% more, 4%, 5% more, it's like, well, why not buy extra cereal boxes right now? Why not buy some extra rice or extra can of soup? I mean, why come back in the future and pay the higher price? I'll just invest in my own inventory. I'll buy the things I'm going to need in the future, and I'll buy it right now. And if I buy, a package of rice, and that same package of rice is 20% more expensive at the end of the year, but I bought it a year earlier, that's like a 20% gain on a stock. You made 20% on that rice. You were going to buy it, but you bought it cheaper because if I just left my cash in the bank, I couldn't afford to buy it anymore. I have to get an extra 20%. And so I think a lot of the inventory might end up getting sold quicker because consumers are doing what I'm doing. They're just saying, hey, I'm not going to wait to buy. I'm just going to stock up, and buy what I can. And there's two reasons to do that. Not just because it might be more expensive in the future, but what I think might happen probably not before the midterms, but before the general election, although it could happen before the midterms, is that inflation is going to be so bad, and there's going to be nothing that's politically acceptable that the Fed could do about it, that they're going to do what's really unthinkable is price controls. Oof. They're going to basically say, you know what, the reason prices are going up is because the farmers are greedy. Those big businesses are greedy. The supermarkets are greedy. The food distributors, everybody is greedy and gouging the consumer. So the government's going to say, no more price hikes. We're going to have price controls. And we're not going to let these greedy companies rip off their customers anymore, right? So this is what happens. But now the minute you get price controls, what happens? Well, there's shortages. The stuff's just not there anymore. So one of the reasons to buy the stuff now is that you may not be able to get it. Now, maybe they'll ration it. Maybe, you'll have a long line. You'll have to wait in line for a couple of hours to get a small quantity of stuff. Now, the other way you get stuff in an environment of price controls is illegally. You go to the black market. And of course, there's going to be stiff penalties for people, right? These traders, these price gougers, who are operating in the black market. But if you actually want to get something, that's going to be the only way to really get it, is in the black market. But of course, all those transactions will probably be in cash because they'll all be illegal. But you can't hold cash. So that's why I tell people to buy silver coins. Buy 1 ounce silver rounds or, junk silver. Because when you want to make a transaction that nobody knows about, that's how you're going to have to do it. You can't illegally sell stuff on a credit card. And so you have to have some means of engaging in commerce in the black market, which I think is coming, unfortunately.
And you don't think that might be crypto?
No, because you can track crypto, right? I mean, it's on the internet. I mean, the government can see people transacting in cryptocurrency. But also, I mean, cryptocurrencies are very volatile. They can crash. They don't have any real value. I mean, if I'm a merchant and I'm selling goods, I mean, do I really want to get paid in Bitcoin? I mean, what happens if while I'm holding my Bitcoin, it drops 20 or 30%? I don't want to do that. I mean, I'd rather get paid, let's say, in silver or gold, something that I know it might, hold on to its value, have something real in my hand that I can exchange. So yeah, no, I don't see crypto actually serving that function. I mean, people are buying it as a speculation, but I don't see it functioning as a medium of exchange, store of value.
Now, last time we had price control, I mean, we've had price controls many times, but we had price controls in 1951 after the Korean War. That ended up just delaying a recession that we got 2 years later. We had price controls that were lifted in the late 60s, and that led to essentially the recession of the early 70s when we had this rampant inflation, and then we left the gold standard and this disaster. Nothing good comes of price controls. But the question I have for you is, you mentioned politics. How much do you think the Fed is influenced by politics this particular year? And is it going to stop them from doing what they need to do to get inflation under control?
Well, they are 100% influenced by politics. They are extremely political, and they're always trying to appease whatever party controls the White House. Because that's who appoints them, right? They're always appointed by the president. And they're also, in a way, trying to appease all the incumbents. They kind of want everybody to get reelected. I mean, that's how they play ball. And so that's why they pursue the policies that they do. They're never looking to do what's in the long-term best interest of the country, which is what they should be doing. That's the whole theory about the Fed being apolitical, right, being independent, because it can act in the long-term interest of the nation and sacrifice what might be expedient in the short run, but they never do that. Everything the Fed does is, we have a recession, we have to stimulate. Well, what if the recession is exactly what the economy needs? What if it's the cure that's going to make us better? It's the bitter tasting medicine that we need to swallow, right? Because the economy is sick and the recession is the medicine. Because what happens is you get these artificial booms, and unfortunately, the Fed is the creator of these booms. But during the booms, you have all this malinvestment, you have capital misallocated, resources misallocated, and we're making all sorts of mistakes during this bubble. But nobody cares about the mistakes because everybody thinks they're getting rich. But then the bubble pops, and we realize how many mistakes we made, and now the economy has to be rebalanced in a viable way again. Resources have to be reallocated. People have to lose jobs in certain sectors so they can get jobs in other sectors. Capital has to be reallocated from the bubble area to where it can be used more efficiently. In other words, we have to stop funding money-losing companies that make things that nobody needs, and we have to free up that capital to start producing the real goods that we do need. We're running a huge trade deficit because we're not making enough of the stuff that Americans actually need. We're wasting our resources making stuff nobody needs, right? Because it's all part of the bubble. So all of the mistakes get corrected during the recession. But when the Federal Reserve comes in and tries to mitigate that recession and cut it short, what it's actually doing is stopping the economy from healing. The free market is trying to fix what the Federal Reserve broke during the bubble, and then the Fed comes in and prevents it. It's like you have this big, you're high on drugs, and I check into rehab and I stop taking drugs, and now like my body is like starting to have convulsions. I'm going detox, and then the Fed comes in and just gives you a bunch of drugs so you'll make you feel better, right? And interferes with this process,
Right.
And so now you're high as a kite again, and you're doing stupid things, and that's what the Fed keeps doing, because the voters, when they're in detox, they're not reelecting the guys that put them there, right? So they're always trying to get the voters to feel good and give them more drugs, so they'll reelect the guys in power. And so but they're not going to be able to do that. They're going to try. They're never going to stop trying. The only reason Powell is talking about raising rates is because he thinks he can do it. without hurting the economy. He thinks he can do it without causing a recession. He's wrong. I mean, just like he was wrong about inflation being transitory, just like the Fed was wrong when they said the subprime problem was contained, the Fed is wrong about everything. And so they're wrong about this.
Why does it seem like so many things sound so similar to 2006-ish right now, where we hear a lot of folks saying things like, we're coming in for a soft landing. Everything's going to chill out and it'll all be okay. It's like somebody playing the violin on the Titanic. Is that too extreme of an analogy?
Yeah. No, when they talk about soft landing, grab your crash helmet, because it's never a soft landing. You know, this thing ain't going to land, right? There's no way to land it. So it's just a question of where it crashes and how. But you know, you don't have to stay on the plane. That's the thing. I'm helping people get off, and so they don't have to worry about whether it's a soft landing or a crash landing. Just get off, right? And I call it like the Titanic. You know, we're going down on the Titanic, but I got these lifeboats, so hop on board, because I think if you're in good, solid companies, foreign companies, in countries that are in much better fiscal shape than the United States, countries that run surpluses instead of deficits when it comes to trade, where they're not, as loaded up with debt, where their people save more and actually produce more. These will be relative safe havens. There are good companies in those countries that you can buy at fair or cheap valuations historically, get good dividends, and load up on the things that work in an inflationary environment. Look at the oil stocks. We've been overweight oil. We added to our oil stocks last year when oil went negative, but they were giving these oil stocks away. But oil stocks are going to do very well in an inflationary environment. So will agricultural stocks. So will industrial material stocks. But also emerging markets. They do very well when the dollar is weak and the U.S. market is weak. I mean, look how well they did in the 2000s when the U.S. market was getting killed. I mean, people were making money like crazy in emerging markets. They were making tons of money in oil and gold and agriculture. So all that stuff is going to work again. I think it's going to work even better this time because we're going to have an even bigger round of inflation, and there's no way to stop it. I mean, think about what it took to stop inflation in the 70s, because the last time inflation was this bad, it was the 1970s, right? Even if you accept the government's methodology, you still got to go back to the 70s. So how did we stop inflation in the 70s? The Fed funds rate or discount rate went up to 20%. Now, the highest the CPI ever got was 1980. It was up 13.5% in 1 year. So the Federal Reserve moved interest rates 6.5 percentage points above the inflation rate to get inflation under control. So if inflation is 7% now, we'd have to go up to 13.5% to have the same distance. Except inflation isn't 7%, it's 15 if we measured it the way we did in 1980, which means we have to take interest rates up to 20% again, which is impossible. I mean, we couldn't even get them.
The thesis is that the supply chains will get better and then prices can stabilize. Maybe not necessarily come down, but stabilize, and then inflation's flat. Wouldn't that be the case?
No, I mean, it's not the supply chains that are the big problem. It's the demand. The demand is coming from money printing. I was one of the few people early in the pandemic, at the very beginning, in March of 2020, when everybody was talking deflation. I was on my podcast saying this is the most inflationary situation that you can imagine, because on the one hand, we are sending people home from work, so people aren't showing up at work, so they're not producing goods and services. So the supply of goods and services is going down. But instead of demand going down, which would normally happen if people didn't have jobs, so they wouldn't be able to buy stuff, the government made the mistake of sending people money who no longer had jobs so they can keep spending. In fact, we made the even bigger mistake of giving people more money after they lost their jobs than what they used to earn when they still had jobs.
That's true.
So we had the supply of goods and services going down, yet demand was exploding through the roof for the goods and services that we weren't even producing. So it was a function of all this new demand that was the problem. In fact, America has never imported more stuff than it imported last year, right? So more stuff came into this country in 2021 than in any prior year. So we got all this stuff. That the stuff isn't the problem. We got too much money chasing that stuff. Too many people got money for not producing. And so prices are going up. And yes, there is a problem with the supply chains, but probably because we overwhelmed them with demand, right? I mean, I talk about it on my podcast, but let's say the government gave everybody $1 million, right? Just printed it up, sent everybody a check for $1 million. And now everybody has $1 million, and so they all call up the Ferrari dealer, and everybody wants to buy a new Ferrari. Well, I mean, how many Ferraris can they make a year? They're going to say, oh, well, you know, Ferrari prices are going to skyrocket, and they're going to say, well, it's a supply problem. It's a bottleneck. There's not enough Ferraris for everybody. Of course not. It takes a long time to make these cars, right? You just can't, produce them like magic. So whenever governments print a lot of money, they always blame the problem on supply. But the government can't print supply. The government can't print stuff. They can print money and give everybody money. But the money doesn't have any value unless we produce stuff first. And that's what people don't understand. They think the money has value. If I only had more money, we'd all be rich. No, we have to produce more stuff for us all to be rich. If we just all have more money, then all the stuff just costs more. You cannot print yourself into prosperity. You print money, you get inflation.
Now, not considering the rest of the child tax credit that's coming, which comes as a refundable tax credit to folks. It's basically another stimulus check coming in the next few months for millions of families. Outside of that, we're running out of stimulus. No more unemployment boost. The forbearances are ending. The child tax credit's over. Build Back Better didn't pass. Who knows? Maybe we'll get a piece. Maybe we won't before the midterms. Let's assume we won't. It sounds to me like the fiscal stimulus is ending. So at some point, people got to stop spending.
No, it's not ending. I mean, the additional stimulus, but the government is running about a $3 trillion a year budget deficit. That's stimulus. I mean, think about all the people who retired in the last couple of years, right? These are people who used to pay Social Security taxes, and now they're collecting Social Security benefits, right? So these people aren't working anymore, but now they're getting money to spend, right? That's all stimulus. True. And a lot of people retired early because of COVID, and they're collecting. So you have this bigger gap now between what the government collects in Social Security taxes and what it's paying in Social Security benefits. So that stimulus is there. I mean, and then you have all the other government entitlements. And what about now these cost of living increases? Everybody on Social Security is going to get a big increase because of the CPI. Where's the tax increase to support that? It's not there. So there is a lot of stimulus already baked in the cake, even if we don't get extra. So all that stimulus is inflation because it's all funded by money printing.
That's a very good point. So, maybe it won't be as much, but you're right. You still have these stimulative aspects. So you believe whether it's poor individuals, maybe they don't need to spend as much. Maybe people with more money just keep spending. You think either way, though, the net average is people are going to continue to demand, continue to spend more, unless there's some form of reason for them to stop spending, like maybe the fear of a recession. Is that right?
Well, here's what we need. We need significant tax hikes on the middle class.
Okay.
That's not going to happen.
No.
We need significant government spending cuts. No. That ain't going to happen. I mean, even Trump didn't cut any government spending. So we're certainly not going to get any spending cuts out of Biden. We need the Fed to go to a tight monetary policy, which means positive real interest rates. The Fed has to get the interest rate above the inflation rate, or the Fed has to start shrinking the money supply, start withdrawing all the liquidity that they supplied. They're not doing any of that. All they're talking about is pursuing a less loose monetary policy than the loose monetary policy they pursued in the past. So if you pour less gasoline on a fire, that doesn't mean the fire goes out, right? You're still fueling it. So I don't see any type of policies that would reduce the inflation. And so the inflation is just going to continue. But when it's going to get really bad is when the dollar finally caves in. Because the dollar is still strong relative to other currencies. Now, it's not strong in the sense that its purchasing power is not falling. It is. So the dollar and all currencies, because inflation is not just happening here. Look at in Europe, they just had the worst inflation in 20, 30 years. They had over 5% CPI gain in the Eurozone in 2021. So everybody is dealing with a rising cost of living. The purchasing power of every fiat currency is going down. But on a relative basis, the dollar has held up because people have had confidence in the U.S. They've had confidence in the Fed. They believe that the Fed has inflation under control, that it was transitory. And for years, the Fed was saying, well, if we're wrong, if inflation is ever higher than we thought, well, we can easily rein it back in. We've got the tools. We know how to deal with high inflation. And I kept saying that's nonsense. They don't have the tools. I mean, if they have the tools, they can't use them because they would destroy the bubble economy that they've been inflating over the years. And when the markets realize that the Fed was all bark and no bite when it comes to inflation fighting, that inflation is going to continue to erode away the value of the dollar, nobody is going to want to own dollars. Nobody is going to want to own a 10-year treasury at 2%, and they're not even at 2, they're like 1.9. But even if the 10-year went to 3% or 4%, if inflation is 10%, you're not going to want that low-yielding treasury. There's going to be no demand for U.S. bonds. The dollar is going to crash. And now the Fed's going to have to print even more dollars to buy even more bonds that everybody is selling to prevent rates from rising. Because here's the other predicament. The U.S. government is insolvent. And the only way that we can at least service the $30 trillion national debt is if the Fed has interest rates at zero. But if the Fed has to raise interest rates to fight inflation, the government can no longer afford to pay the interest on the money it borrowed. So now what is it going to do? It either has to default on the treasuries, or it has to significantly increase taxes or cut spending, neither of which it's going to do. So we're in an impossible situation.
Sell bonds?
Huh?
You think they could sell bonds to finance their rate, kind of like borrow to pay their borrowing?
No, you can't do that but they have to pay even higher interest on those bonds. And nobody wants the bonds they've got. I mean, we've been able to get away with this for a long time because nobody cared, right? Nobody worried that if we could repay the money. Nobody cared about inflation. But the minute the markets care, and you have all kinds of countries that have gotten into trouble, right? That borrow too much money. Whether it's Greece, Argentina. You look at these examples. Here I'm in Puerto Rico, right? For years and years, the Puerto Rican government was borrowing all this money, and nobody cared that they couldn't pay it back. And they kept borrowing and going into debt until finally somebody cares, and then they go bankrupt. I mean, because, so this is what happens. I mean, it's not a problem until it's a problem. Of course, it is a problem. It's just that nobody cares about it. And so they let the problem get worse until it's a crisis. And that's what we're going to have. We're going to have a debt crisis, sovereign debt, currency crisis, because I think when they have to choose between inflation and default, they're going to choose inflation. And so people are going to get paid what they're owed. It's just the money they get paid in won't buy very much. So the losses are in purchasing power. You get your money, but your money doesn't have any purchasing power. So what good is money that doesn't buy anything?
Now, what do you think about the potential that inflation might be reduced via a shift of spending from goods to more services?
Well, first of all, services prices are up a lot too. They're up a lot more than 2%. And a lot of people that provide services, they need raises because all the goods that they consume are getting a lot more expensive, right? So the guy that cuts your hair, he needs a raise because he's got to feed his family. So I mean, a lot of the people that provide services are going to be getting wage hikes, and maybe they won't be enough to fully offset the increase in the cost of living, but it will cause higher prices for services. So I think the idea that the reason we have inflation is because everybody is buying goods instead of services, I think that's wrong. I think when people start buying services more, those services costs are going to skyrocket. I mean, try to find the people. I just got a letter from the pool company that takes care of my house in Connecticut. And the letter I got said that due to the labor shortage, we're not going to have enough money to service the pools that we normally service. So we're just going to have a first come, first served basis, and we're going to have to cut off, so if they actually needed to service everybody's pool, because they would actually have to really jack up what they're paying people to start, cleaning pools again. I mean, I don't know what it is, why they can't find people to clean pools. I mean, they've been able to find people to clean pools all these years, and all of a sudden it's like, oh, there's nobody there. We can't do it. So I just think that when demand for services come back, you're going to be surprised at the degree to which service costs really start to go up. But over the long run, I think goods prices will rise much faster than service prices when the dollar tanks. Because once the dollar tanks, it's all over for goods because we're importing most of our goods. Our services are mostly domestic, right? But also, Americans, when we buy goods, we compete with people all over the world for those goods, especially when the goods aren't even produced here. So we have to compete with everyone in China or everybody in India or all over Europe or Asia for products. So there's a lot of demand. But when it comes to services, like I mentioned, a barber, right? I don't compete with the Japanese or the Chinese when I want to get a barber because they're not going to fly over here to get a haircut, right? So it's just Americans, and it's only the people that live, in a certain, maybe within a half hour of where the, guy's salon is, right? That's who I'm competing with. So I have a much smaller group of people that are bidding for the services of that, hairdresser. So I think services prices won't go up as much. Like, I remember when I was a kid and I was backpacking around Europe and I would go and I have to get a haircut. They were really cheap. I was getting my haircut, in Europe, like in Greece, for a couple of bucks, where maybe I was paying, $15, $20 to get a haircut in America. I was going into a place in Greece and it was like $2 or $3 because it was a poorer country. And so the wage rates. But if I went into a store and I looked at, what's the price of a Sony TV, it was almost the same as what the Sony TV would cost if I bought it in the US, because that's a global product and the people in Greece have to compete with the people in America who want, the limited supply of, Sony TVs. But that guy cutting hair, in Athens, I mean, he doesn't have, there's no one in America that can, unless you're there, like I happen to be there, for the summer, and then I can take advantage of that cheap haircut. But most of the time, I'm not there. And so that's what's going to happen in America. Service prices are going to go up, but they're not going to go up nearly as much as the price of goods.
What do you think about the potential then that if services move up and then the cost of goods go up and we do hit this inflationary environment and the Fed tries their best to continue to raise rates, which jumps or hikes up the 10-year treasury bond yield, which then hikes up mortgage rates, what's the potential we're going to see some of this spill over to the real estate market?
Oh, yeah. And, a lot of people forget that interest rates are also a cost, right? And so as the Fed is raising rates, even if it's not raising them a lot, there is an impact on interest rates that consumers pay. And in fact, mortgage rates are going to be particularly impacted because the Federal Reserve has also been buying mortgages. And the Fed is not going to be buying as many mortgages. In fact, it might not buy any mortgages. In fact, it may sell mortgages because what Powell said is the Fed wants the balance sheet to basically be exclusively U.S. Treasuries, meaning that what they want to get rid of is whatever's not a U.S. Treasury, and that would include a mortgage security. And so the demand for mortgages is going to go down, which means the price of mortgages is going to go up. And obviously that impacts the ability of people to buy a home. But what's going to be more significant is the higher interest costs that landlords are going to deal with, because a lot of landlords don't own their properties free and clear.
Right.
A lot of landlords also have mortgages on their properties. In fact, they acquired a lot of their properties by borrowing money against the properties they already own. And they have to service this debt. And so as their cost of funds goes up, they only have one way to recoup that from their tenants, their customers. So it becomes another cost, just like your utility costs and your property taxes and your maintenance and everything is going up. Now the interest payments on your loan is going up. So now you got to jack up your rent even more. And in fact, a lot of businesses also have debt. A lot of businesses borrowed money to make capital investments. Well, now their interest rates go up. they've got to pass on those higher interest rate costs to their customers in higher prices. So it's kind of a paradox from most people's way of thinking. But these initial rate hikes from the Fed are going to make the inflation problem worse, right? Because they're going to be higher costs that are going to get passed on to consumers.
I haven't heard somebody make that argument before. I mean, that's kind of right. I mean, the theory, I suppose, is that eventually demand might slow down if you raise rates enough. But in the short term, now all of your credit lines at every single company that has wholesale credit lines are more expensive. And so now they have yet more costs, and they don't want to show negative margins. So what do? While consumer demand is still up, they raise prices more.
Yeah, they're gonna raise rates enough to make inflation worse, but not enough to bring it down. They're not going to do it enough. And it's not just raising rates. That you have to shrink the money supply. You have to withdraw the liquidity that you provided. You need less money out there so that it's more in balance with the diminished supply of stuff. You know, so and a lot of people think, well, you know, when people go bankrupt, right? When stock prices crash or real estate prices crash, you know, that's going to take purchasing power away because people aren't going to have as much wealth. And to some extent, yeah, I mean, people will have to start saving more when their stock portfolio is decimated and they've lost their home equity. But you have to look at what's going on all over the world, because even if demand goes down here, demand can be going up in the emerging markets. And so net overall, there's more demand worldwide. Even if there's less demand in the U.S., there's more demand globally. And so, you know, Americans are just going to end up buying less stuff, but paying more money for it.
Well, and so how soon do you think we could actually see 2 quarters of negative GDP?
Well, I guess the soonest we could see it would be July, right? Because the first quarter would be the first quarter of this year, which is the soonest. And then
so you think right away?
Yeah, well, that's the soonest. Yeah, it would be right away. Yeah. But the interesting thing is, if we're getting the news of a recession, right, we're not going to get that news until July, maybe August, because sometimes, you know, let's say we get a negative quarter for the first quarter. Then when we get the second quarter, we get the initial estimate maybe in July, but then they revise it in August and again in September. So we may not know that we're in a recession officially until just before the midterm elections, right? So So the problem there is, I would think that if I was Biden and, you know, Yellen and the top Democrats, I would not want the economy to be just officially in recession, you know, within a month or two of these elections. So you would think that if we got a negative quarter in Q1, which we would know, you know, April, that they would want the Fed to do something. Now, the first rate hike is supposed to happen in March. Right. But can you imagine if we have a negative quarter, is the Fed going to keep hiking rates all throughout the second quarter, looking back at a negative quarter in the rearview mirror? I mean, will the political pressures not, you know, hey, you got to stop this. But that's why I'm thinking that maybe they'll try to slip some price controls in, because that would be the only way they can temporarily put a lid on prices, because they're not going to want the Fed to do it with rate hikes when we're already, you know, teetering on the edge of recession.
How does this all play out? Do we just have to go through the pain like we got Volckered? Are we just going to have to get Volckered again? Like, where's the good news?
There is no good news. I mean, the good news is eventually it'll be over. I mean, but we got to get started before it could end. But it's going to be much worse than what we experienced in those early years under Volcker. I mean, the U.S. economy is in far worse shape now than it was then. I mean, we had trade surpluses. We were a wealthy nation, creditor nation. You know, I mean, what was our debt to GDP? 30% back then? I mean, it's not, now it's like 130%. We were in much better shape to withstand, right? We had this bitter tasting medicine, but, we had a healthier body. I mean, now the medicine could kill us. We're so fragile. The economy is so heavily indebted. But that's why they've been kicking the can down the road for so long, because dealing with the problems are so bad that nobody's wanted to deal with them. But every time we postpone the pain, we make the pain worse because we make the problem worse. But I've been saying all along, look, we can't keep doing this because when we finally can't do it anymore, it's so much worse. We've been digging ourselves into this hole, for 20 years. I mean, it's so much deeper now. I mean, we should have stopped digging, right? That's the first rule of holes. When you're in a hole, you stop digging, right? But we're in the Grand Canyon now. We've been digging for so long, and so it's so much worse to try to deal with this. But I mean, all I could do, is individually, we can position ourselves to financially come through this as best we can. I mean, look at the decade of the 1970s. Who came out on top during that inflationary decade? It was the people who early in the 1970s, right, understood what was going to happen. Right. They sold their U.S. bonds, they sold their U.S. stocks, they sold their U.S. dollars, and what did they buy? They went and bought stocks in Japan. They bought stocks in Germany, right? They went and they bought commodities. They bought gold. They bought oil. They did all this stuff, and they made a killing during the 1970s, right? Those markets exploded. Gold went from $35 an ounce to $850. I mean, think about that move. Think about what happened to stocks. The foreign currencies almost tripled. The dollar lost about 2/3 of its value, so you tripled your money just in a foreign bank account. But of course, you made a lot more if you bought foreign stocks. So people made a lot of money, and those were the people who were in the best position to take advantage of a 700 Dow, of 14% interest rates on a 30-year Treasury. The people who got out of Dodge early, right? They were solvent. They had made so much money on their foreign stocks and gold and commodities and stuff like that that they were able to buy what everybody else was selling because they didn't read the writing on the wall in time, and they got caught in the collapse. So what I want is for myself and for my clients to get off the Titanic before it sinks, so that we're in a position to take advantage of what happens, right? Or maybe even to help rescue some people out of the water. But we get into the same stuff that worked in the 70s, only it's going to work better this time because, again, it's a bigger problem, and there is no Paul Volcker or Ronald Reagan on the horizon that's going to do the right thing. And even if they were there, doing the right thing would be so much more painful now and so much more disruptive to the markets, but it would create an even better buying opportunity for the people who are in a position to buy. Because if you're just in dollars and U.S. stocks and bonds, you're not in a position to buy anything. You're going to be desperate in selling, and you're going to be selling at rock bottom prices. It's the people who got out early, who won't be in a financial emergency, will have the resources in foreign assets that we could repatriate, gold and silver that we could sell to buy U.S. stocks when they're such a cheap price. Or U.S. bonds and things like that. So that's what I'm positioning for. What I'm afraid of is that we never get that opportunity because we never do the right thing. And then we just, that would be the worst case scenario. But I don't want to find out how bad it's going to be, in those assets. I want to be in a position of safety so that I can watch what happens from a better vantage point and hope for the best. But I'm prepared for the worst. But either way, I think I make a lot of money.
Right. And one of my concerns that I have in comparison to the 70s is we're a much more globalized economy now, and I understand seeking safety in some of these commodities and other countries, but what happens if we end up having more of a 2008 style recession where a crash here in America affects everywhere? I mean, then it sounds like the only thing that is safe is cash.
Yeah, we've always had a global economy. I mean, hundreds of years ago, we traded all over the world. It's just the global economy is probably more interconnected and operates faster than it did, but we always had a global economy. But remember what happened in the 2008 situation. The reason that a lot of foreign banks got caught up in this is because they held a lot of our bad mortgage debt, right? We were running these record trade deficits in 2005, 2006, 2007. Now we've shattered those records just recently, but they were records back then. And foreigners were recycling our trade deficits into our mortgage-backed securities. And so we had spread this toxic paper all around the world. And so when it blew up, you pretty much had losses everywhere. But also, you have to look at where the world was in 2008. Oil, again, almost $150 a barrel. The dollar index was down at 73. Gold was at 1,000, which doesn't seem high now because it's 1820, but it was under 300 in 2001. So gold had gone from under 300 to 1,000. You had a huge move up in gold, huge move up. Oil was $20 or $30 a barrel, and it went to 150. So the world was in a very different position when that crisis happened. And emerging markets had had a spectacular run. I mean, some of these emerging market stocks were up 300, 400, 500% going into 2008. That's not the case now. Emerging markets have been dead money for a decade. They've never been this cheap relative to the US. The dollar's been in a big bull market. Gold's gone nowhere. The price of gold is the same as it was in 2011, right? It's 10 years later, gold hasn't moved up. So we're at a very different point than we were in 2008. So instead of running to the dollar because it's so cheap, they're going to run from the dollar because it's so expensive. And they're going to get into gold and commodities and foreign markets.
Okay. Wow. That's it. Does. I mean, that's very interesting. So really, you think the flight to safety is going to be gold, and I think that's also why you're increasing your position in like gold miners now, right?
Well, I'm not increasing it. I've had a big position in gold miners,
okay.
And I still have it. And so now it's it's picking up. We had a very good day today. Again, year to date, if you look at our portfolios, right, we're positive a few percent on the year, which doesn't sound like a lot until you realize that it's the first week of February. So if you annualize that, I mean, we're talking some very good returns if this keeps up. But what's more important or more significant is the U.S. stock market, the NASDAQ in particular, is off to its worst start ever. I mean, look again today. The NASDAQ was down today, and our accounts are up 1 or 2% on the day, on a day where the NASDAQ was negative, because people are taking money out of those high-flying stocks, and they're buying the stocks that I own. The thing is, those high-flying stocks are still flying high. Even though some of them are down 30, 40, 50%, they can drop another 50, 60, 70% or more and still be expensive. That's how expensive they got during the bubble. Meanwhile, the stocks I own, even though they've gone up, they're still cheap. So there's still a long way to go because nobody's been buying value for over a decade. Because why would you? You couldn't afford to own value because it meant you missed out on momentum. And all these portfolio managers were always keeping score quarter by quarter. Everybody was forced to keep pace with everybody else to crowd into these overpriced stocks. And if you didn't buy the overpriced stocks, you underperformed, and then you lost your job. Well, now it's a race to get rid of those stocks.
I see a lot of individuals in the comments bringing up Ross Gerber. He has an investment fund, and one of the things he says is, as an investment manager, he's got to have allocation, in his opinion, to Apple and Google and the top 5, 10 in the S&P and NASDAQ, because otherwise you underperform the benchmark, and then nobody wants to invest with you. And it's kind of reiterating what you're saying, that it's this benchmark sensitivity that's actually sending more dollars potentially in the direction of overvaluedness. And now people see, certain stocks have come down 30, 40%. That makes them cheaper, but like you say, not cheap. So what is the definition of value? How are you finding value? Is it multiples? What are you looking for?
Yeah, well, it's a combination of things. But yes, you look at the price earnings of a stock. How many years worth of earnings am I paying to buy a company? You look at the dividend yield. What is my return if I buy this stock and the price never goes up? What's my dividend? Just like you would look at real estate. What's my rent? What's the cash flow on this property if I buy it? Or if I'm buying a bond, what's the coupon? What does it pay? I mean, back in the day, right, when somebody would talk to their stockbroker, and the stockbroker would recommend a stock, probably the first question that an investor would ask is, what does it pay? Yeah. No one even cares what it pays. No one even cares what it earns, let alone what it pays. It's like, what's the ticker? What's the price? I mean, the price means nothing, right?
Yeah.
But people just want to, it's just a sexy story. It's like there's an old saying, you sell the sizzle, not the steak.
Yeah.
Well, what if you're buying sizzle and there's no steak, right? You don't even realize that you're just buying smoke and mirrors. And that's what a lot of people were buying. But you have all these funds that are loaded up on these big names, because even the funds that weren't index funds were closet index funds. Everybody was afraid to stray from the benchmark, right? You look at my portfolios. I have zero weighting to technology, nothing. We had some Chinese tech stocks for a while. We made good profits in those. We got out of them. But right now we have no tech. We barely have any financials. I mean, I have one, and it's at a Canadian bank. But pretty much I'm so underweight financials. But nobody can afford to do that. Everybody is loaded up on tech. Everybody's loaded up on financials. And they're loaded up on a lot of companies that don't make money, but had big market caps. And everybody's going to be pulling money out of these funds. And what's going to happen is the opposite of what happened, because it was a self-perpetuating cycle. And you can call it virtuous or vicious, depending on your perspective. But I think you mentioned it even before the interview, but look at the, Cathie Woods and her funds, ARK Innovation. This really is the epitome. This, she's the poster gal for this bubble, just like, maybe like a Henry Blodgett, who was the internet analyst for Merrill Lynch, back in the late 90s, with his crazy calls. And, to his credit, he's a little bit more humble now. I think he learned a lot from his past mistakes. But, you have Cathie Wood, who's learned nothing yet from her mistakes, because she doesn't even realize she made them. She will eventually, after everybody loses all their money. But the way it worked is this. So let's say I'm Cathie Wood, and I buy all these overpriced stocks in my ETF. And as I'm buying these stocks, because they're kind of thin, I'm pushing up the price. My buying is pushing up the price.
Right.
Now, because I pushed up the price of the stocks I'm buying, my ETF goes up. Now, investors look at that ETF. Oh, woo, look at that ETF. It's doing great. I want in on that one because it's going up. So now money gets sent in to Cathie Wood, and she gets new money. Oh, well, I got to go buy more of those stocks. Well, now that new money pushes the price of those stocks up. So the more money she gets, the higher the stocks she's buying goes, and the higher the stocks she's buying go, the more money she gets from people who are chasing that performance. So she bids up all of her stocks. She's the biggest buyer in every one of her stocks. Right now, all of a sudden, the fund tops out and starts going down. And now it's going down a lot more than the market. And now in the rearview mirror, the returns look lousy. And so now people are like, I want out. This is no good. I want my money. And now she starts getting redemptions. Now she's got to sell those stocks that are getting beaten up. But when she sells them, they get beat up even more. And now the fund does even worse. And now more people are like, I want my money out. And so now you get a reverse. As money is sucked out of the funds, she has to dump those stocks. The stocks go down, the returns get worse, and more money leaves.
Are you telling me Cathie Wood is the biggest momentum stock?
Well, her fund.
Yeah.
But the same thing is happening on a smaller scale with mutual funds in general that are loaded up on Facebook, Amazon, Netflix, all these big stocks that have done so well. Because they've done so well, everybody has had to buy them. And because everybody has had to buy them, they've done so well. And so it just feeds on itself. But at some point, it breaks. And now it works in reverse. And these stocks are going to be sold for a long, long time. And they're going to be dragging down the performance of every fund who owns these stocks. And more of the managers are going to start to wake up, and they're going to see these value stocks. Hey, this stock went up 30% last year, plus it pays a 6% dividend. Well, why don't I buy that? Right? And then once the value stocks get a little momentum, now more people want to buy them. As the value stocks actually become less valuable, you actually get more demand because now people start looking at the momentum, and they want to get them. So at some point, right, if you're a value investor, your value stocks become overpriced, and then you're going to sell and try to find the next value. But I think we're a long way off from that point. I mean, that might happen in a few years.
So Cathie makes this argument that we're going to see this convergence that'll lead to this insane exponential growth in DNA sequencing, energy storage, adaptive robotics, and blockchain technology, that these things together, and genomics, that these things together are going to lead to explosive cash flows in the future. Is she wrong that those things are going to do well, or are those things going to do well? And the big issue isn't that they're not going to do well; it's just that they're way overvalued.
Yeah, I mean, first of all, she's got to say that kind of stuff. I mean, maybe she believes it, maybe she doesn't. I mean, but sometimes you get kind of caught up in the mania, because she's at the center of it. And, she probably believes a lot of the stories that were written about her. Oh, she's so smart. She's a genius. I mean, she just bought the most overpriced stuff and it went up. It's not that she was a genius. She just got rewarded because so many fools thought she was a genius and gave her their money. And she foolishly invested it. But look, some of the things that she's saying may in fact come to pass, but it may not work to the profit of her investors, because her investors will go broke long before that stuff comes to fruition. But a lot of the stuff that's being said, is just pie in the sky nonsense. And it's certainly a lot of the stuff related to cryptocurrencies. I know one of the things she says is that, technology is deflationary. We don't have to worry. Yeah. Well, the capitalism is deflationary. I mean, that's what's great about capitalism. I mean, not deflationary in the true sense, but in the price sense, right? Capitalism results in lower prices. That's the beauty of capitalism, because capitalism is about abundance. It's about productivity. It's about making more with less. And so as you come up with better ways, right, to build that mousetrap, the mousetrap gets cheaper. And so capitalism is always reducing prices. That's not changing. But what's also not changing is that government always increases prices through inflation. The government debases the money. So you have a war between the market that's lowering prices by producing more stuff and the government that's raising prices by producing more money. And for a while, the market was able to offset the money the government was printing. Not anymore. They're just printing way too much for the productivity to keep up. And so she's right. Yes, we're going to have some advances in productivity due to technology, but it's not going to be enough to offset this massive money printing.
There's this old famous saying that securities are sold, not bought. Basically, that the better you can market your ideas and visions, the more money you get for your stocks. With that said, at what point is Peter Schiff going to be selling us on Tesla stock?
On Tesla?
Yeah.
I mean, look, Tesla, if at some point in the future, Tesla is cheap and it pays a good dividend, I mean, I may be looking at buying it. I mean, we don't, we own, I think, one auto stock in our portfolios, a European auto company.
What is it? GGPI?
Daimler,
Okay.
Yeah, I'm not allowed to really recommend stocks, on a podcast or on my show. I don't. So we own it, but because I don't know, just because I mentioned a stock doesn't mean I'm recommending that anybody buy it, because I don't know everybody's circumstances. It may be suitable for one person, not somebody else. So
that's why financial advice.
Yeah, if you really want to know the stocks that I think you should buy, you got to call up Europe Pacific Capital and talk to my brokers. And then once we understand your circumstances, we can give you recommendations. Or better yet, just let me manage your portfolio. Set up a managed account, and I'll buy you the stocks I think you should own, right, based on the circumstances that you're looking for. But if you look at a stock like that, it's the valuation is much better than Tesla. Mm-hmm. And there's nothing that stops them from making electric cars. I mean, everybody's making electric cars. See, the problem is Tesla moves first, right? And they make these cars and everybody wants to buy them and they start making some money. But then when you're successful in capitalism, you create competition. And investors tend to forget about that. They just assume that the lead you have, you're always going to have it. But you don't have it, because the minute you start making money, you're sending a signal. And there's a lot of car companies all around the world with pretty smart engineers. It's not like Tesla's got a monopoly on these guys. And they see, Tesla's making a bunch of money selling electric cars. We want to sell electric cars. We want some of that money. And it's going to get a lot more competition. And there's no way the valuations. Now, a lot of people say, well, look at Amazon, right? Because, Amazon has defied a lot of people's like me, and I've been looking at Amazon and say, look, it's overpriced. It's a great company. I use it all the time. I'm a great customer. I don't know how they make any money on me. I mean, it's incredible. I mean, every day, a dozen Amazon packages show up at my house in Puerto Rico, and they get shipped here for nothing. Yet I know how expensive it is. Like if I want to ship a small package that weighs maybe 5 or 6 pounds to the U.S., it costs me like $25, $30 by the post office. Yet I get a 40-pound bag of dog food coming to Puerto Rico for free shipping. So, I mean, it doesn't make any sense how Amazon can get all this stuff to my house for nothing, just for the $100 or now. They jacked up the price of Amazon Prime to, by 17%. They can charge me thousands of dollars a year for Amazon Prime. I'd still pay it. Hopefully Jeff Bezos isn't listening, because I don't know that they could fine tune it. But so I've always been I've loved Amazon as a customer. I think they give me incredible value. I just don't see how they make any money. But they've gotten so big, and a lot of it is because of this low interest rate environment, and they've been able to price things so low and get market share. But at some point, this bubble is going to pop. I mean, Amazon stock's going to tank. Look what's already happening to Facebook. Right? It's finally starting to implode. People are starting to realize that, and I was saying this years ago. I was saying, what's good about Facebook? I mean, as soon as the young people saw their parents and their grandparents on Facebook, it was over. It wasn't cool to be on Facebook. That's why they bought Instagram, but then they started using TikTok. And what's Instagram? I'm using TikTok now. And everything changes. Yeah. And so people forget. They just assume that if it's popular today, it's going to be popular forever. Well, no. I mean, things come in and out of fashion, and if you're good at something, that breeds competition, and your success is fleeting in capitalism. You have to be on your toes. I mean, Apple's been on top for a while, but I remember, in 2000, I mean, you couldn't give away Apple stock. Everybody hated Apple. I mean, it was like the one stock that didn't go up during the 90s, the tech bubble, right? It was the butt of everybody's joke. And then all of a sudden, Apple started, hitting the ball out of the park. Are they going to do that forever? I doubt it. I mean, capitalism is very dynamic. There's a lot of competition. I got a lot of Apple products. So people lose track of it. But when everybody's looking at Amazon and saying, oh, you see, this is proof. Yeah, Amazon is like 1 in a million. Think about all the stocks in the 1990s that don't exist anymore. The vast majority of those bubble stocks went to zero, right? And Amazon, I think a comeuppance is still coming. I think there's still going to be a big drop in that stock because I don't think they're at a level really where they can be profitable in an inflationary higher interest rate environment. I think they're going to have to dramatically increase their prices, and when they do, their sales are going to fall. And when their sales fall, the stock's going to crater because it's going to lose that premium multiple, and it's going to have to find a real valuation. So the same thing is going to happen to a Tesla. I don't know where that is, but that's why what I'm doing, instead of trying to be the genius and figure out, the next Amazon, or just figure out what company can make a lot of money in the future that's not making any money right now. Why don't I buy the companies that are making a lot of money right now, that have been making a lot of money for 50 or 100 years, right? They're not going to stop making money, but I can buy them cheap. I can look at his history that says, hey, here's this company, and looking at 50 or 100 years of history, this is really inexpensive. This is a low price for this stock. I mean, there's a lot of stocks that I'm buying where they're cheaper than they were 10 years ago. They're cheaper than they were 20 years ago. Find a stock in the S&P that you could buy for less than it was 20 years ago. And I'm getting paid good dividends, right? So I'm buying real value. Other people are guessing. They're buying a pig in a poke. I'm getting real value, and I don't care if I have to wait to get paid, because I will get paid. And the longer I wait, the bigger that payday is going to be.
So I'm looking at Daimler, and Daimler right now has got maybe a 5 price to earnings ratio, really inexpensive. Relative to the other madness we see. It's got a 2% dividend yield. Coming out of the bottom of the pandemic, the thing's up 227%. From before the pandemic, it's about up 40%. It did get hit, though, when we had that crash in March. How do you prevent getting reamed during that sort of fall if we end up having that kind of fall, or do you just ride through it?
Well, remember, so I've got a portfolio of stocks. So when I look at Daimler, I'm looking at how it fits into an overall portfolio that may have 30 different stocks in it.
Okay.
So Daimler can go down as long as other stocks are going up, right? So that's part of portfolio management, to build a team of stocks that works well together, right? Where you can maximize your returns and minimize your risk. So I have stocks that will do very well in an environment where Daimler is stumbling, right?
Okay.
And so that's part of it. How on its own, you could say, yeah, there's a lot of risk there. But if I think about the things that might hurt Daimler, those very things are going to help other stocks that I own. Now, it's possible that all my stocks can be going up. Sometimes that's happening. It's very rare that they're all going to go down. I mean, I think that's more rare than them all. It's possible. But, it's rare. And meanwhile, they're all paying dividends. Daimler is not a big dividend payer. But one of the reasons, too, for that low PE is it's more cyclical in nature. So autos are generally going to trade at lower multiples, because you're not going to pay up if sales are good. There's going to be a big cyclicality to the auto sector. Whereas, like, let's say consumer staples, things that consumers are buying pretty much every year, in a predictable amount, right? You can have a higher multiple for that earnings stream because it's far more dependable than an earnings stream that's going to be flowing, volatile, get way up and down. But when you buy something like Tesla, I mean, Tesla's worth more than all the other automobile companies combined, and then maybe double them. I forget where it is now. I kind of lost track.
Sure.
But Elon Musk is a smart guy, but he ain't that smart. But meanwhile, he's selling. Look at how much stock Elon Musk has just sold. I mean, he's laughing all the way to the bank. Tesla can go to zero, and he's still a billionaire just based on what he sold. So he's already taken his chips off the table. I mean, he's playing with the house's money. That's what's going on with crypto, right? People made a lot of money in crypto, but you got all these guys, these hodlers, young kids that have never sold anything. I mean, they got all their money, this smart money that got in years ago. They've been pumping it and dumping it. I mean, we've got 4 ads, I think, in the Super Bowl for crypto companies. But think about last year, because even though Bitcoin just had this 35% rally in the last week, just kind of like a rip-roaring, rally, right? Bear market rally, I think, sucker rally. But it's still down year over year. Bitcoin was about 4 or 5% higher a year ago than it is today, year over year. What happened during that year? You had massive advertising campaigns, publicity. All these networks were bombarding you nonstop. Crypto, Bitcoin, all the altcoins were coming out, the ETFs, all these funds that were crypto-related stocks. You had all these celebrities coming out endorsing various cryptocurrencies, NFTs. You had politicians, I'll take my salary in Bitcoin, New York, Florida. I mean, unprecedented. You had El Salvador, we're going to make it legal tender. All this hype, all this, you can't turn on CNBC last year without being bombarded nonstop. Every commercial break, there's a Bitcoin commercial, sometimes a couple of them in the same break. And between the commercials, you get infomercials. You get all these guys that work from crypto companies telling you how great crypto is and how high Bitcoin's going to go. And every single on-air analyst is like, yeah, yep. Everybody is bullish. And the price went down. People lost money. So you got to say unprecedented ad spend, unprecedented promotion, all this publicity, and the price went down. Almost everybody who bought Bitcoin last year is losing money. How is that possible? Because people were selling. Who was selling? The same people who were paying for all those ads, all the promoters. They were the ones that were selling. Right?
Now, Pete, what is this rumor that your son's buying up Bitcoin?
He is, and he's not buying it up because he's only 19, doesn't have that much money. He's a student. But yeah, and it's funny, I get a kick out of it because people want to say, oh, your son is buying Bitcoin. And I'm saying, look, my son is 19, he's never really had a job, although he's got like a part-time job now, so he's starting to work. But my son was buying Bitcoin, when he was 17 and 16, and people were saying, follow your son's advice. Why? He's a kid. Why? He should be following my advice. But when people tell me they want to take my son's advice over mine, I say, I got more kids. I got an 8-year-old. I can ask him what he likes. You can follow his advice. In fact, I got a 5-year-old daughter. I mean, you might as well, take investment advice from her, right? I mean, this is what happens in a bubble. The fact that young people who have no experience, right, no wisdom, they haven't gone through these cycles, the fact that they're foolish enough to buy this doesn't mean that you should follow their lead and say, oh, you see, look, all these young, inexperienced kids are buying it, so it must be right. No, it's the older people who have wisdom and experience that aren't buying it. Look at what Warren Buffett says about it. And there's a lot of big investors and even a lot of these Wall Street firms that are making it available to their customers. You ask the CEOs and the big, they're not buying it for themselves. They wouldn't touch it with a 10-foot pole. But they're like, well, if my customers want it, I'll sell it to them, right? Sure. But they know it's no good. So they're not buying it. It's like, probably people that run casinos, the guy that owned the casinos, doesn't mean they gamble themselves. Why should they gamble? They own the casino. They make all the money everybody else loses.
Wow. So when my theory has always been, and I want your thought on this, that we will hit bottom when the Fed comes out and somehow figures out how to U-turn. Now, we've talked about how challenging that's going to be for them, but I'm just looking at history here. 1987, we bottom out with the Fed bailout. Dot-com bubble ended in 03 when the Fed bailed us out. Recession ended in 09 in February when they bailed us out. December of 2018 ended when the Fed U-turned on rate hikes. March of 2020 ended only when they said we're going to do infinite money printing. If we hit a recession sometime over the next 12 months, at some point the Fed's going to have to conjure up something to bail us out again and kick the can down the road again. Would you invest in tech companies at that point when the Fed comes back in and starts printing again?
No, because I think that bubble has been pricked. And here's the difference. There was no inflation during any of those periods. Mm-hmm. But if I'm right that inflation doesn't ease up, but we slip into recession anyway, we have stagflation,
right?
Something that we haven't experienced since the 1970s, then you got to go back to see what worked in the 70s, because that's the last time we had it. We didn't have it during these previous cycles. So I think that the Fed is going to pivot. They are going to go from less loose to more loose, because they never went to tight, right? It was just, we won't be as loose as we were, and now we have to be more loose because everything is collapsing. And remember, I've been saying this, right? If you go back and you look at what I was saying even before the financial crisis, because I predicted it when nobody else said it was possible. Then after we had the financial crisis and the Fed did QE1, I said it's a mistake because, and they didn't call it QE1, they just called it QE because everybody assumed they were going to do it once. It was one and done, right? And I said, no, they're going to do it again because it's not going to work and they're going to do it again. And I was saying, they're going to have more QEs than Rocky movies. I said they checked us into a monetary roach motel. I knew that they couldn't stop once they got started. It's like, it's easy to start a drug habit. It's difficult to kick the habit, right? So I knew they couldn't kick the habit. And so I got that prediction right. Then when the Fed finally said we're going to raise rates, I kept saying, look, they're not going to raise them. They raised them very, very slowly. In fact, they only had one rate hike until after Trump won. People forget that up until Trump beat Hillary Clinton, interest rates had only been raised one time from zero. We were at 25 basis points. So all of those rate hikes occurred after Trump was elected. And the highest they got was 2.5%. And the whole time I said, they're never going to get to normal. They were shrinking the balance sheet. They said it was going to be like watching paint dry. I said, no, they're never going to complete this journey. They're going to have to do an about face. And I was right. And in fact, live on Fox Business, 2 days before the Fed's last rate hike, I said that if the Fed hikes rates, in December, which was in a couple days, it's going to be their last hike. And the very next thing they're going to do is cut rates. Nobody believed that. Everybody thought they were going to hike rates 3 or 4 more times in 2019. Instead, I was right. They cut rates, right? Because I understood the bubble economy that they had inflated. Everybody else still lives in fantasy land. They think what the Fed did worked. I know it didn't work. And so I knew they were going to do the last about face. I've known about everyone. And the same thing is going to happen again. The Fed is going to reverse course long before we get to 2.5%. We can't make it that high this time because we have so much more debt than we had in 2018. And so they're going to pivot. But since they're pivoting in an inflationary environment, there is no way that they're going to get people going back into tech. What they're going to have to do is buy the inflation hedges. See, right now, the real inflation hedges like gold, right, they're not moving up because investors, while they are cognizant that there's a risk of inflation and they can see it now, they still have faith that the Fed's going to, put out the fire, right? So they're not worried about inflation permanently. They think the Fed is going to take care of it. But when the Fed is forced to reverse course again in the face of high inflation, and so they were never able to get it back down to 2% like they claimed, and here they are again, back at zero doing more QE, it will dawn on people, and it should have already dawned on them, but I mean, sometimes you need a safe to drop on your head, I guess, when you're an investor. But they're going to realize that this is permanent inflation. We're never going back down to 2. And it's QE infinity, which is what I said from day one. In fact, even when Ben Bernanke lied to Congress and said that he wasn't monetizing the debt because it was just temporary, the government was only buying these bonds temporarily, it was going to sell the bonds, I said that he's lying. They're never going to sell the bonds. And I was right. They still own them. Any bonds that matured, they just bought more, right? We did monetize the debt. And so the world's going to realize that we are a banana republic. We are permanently monetizing our debt. The dollar is a bottomless pit. And then people are going to buy the inflation hedges because they're going to realize that inflation is here to stay. It's not going to be, taken care of with a few rate hikes. And that's where people are going to go. When the Fed pivots, it's gold that's going to take off, it's silver, it's commodities, it's agricultural commodities, energy, it's going to be emerging markets that are going to be on fire. That's what's going to really go up. Right now, those markets are going up slowly. They're just going to go up even faster in that environment. But people are not going to take refuge in the stuff that they were taking refuge in when there was no inflation.
Yeah, now this is very interesting because if we hit stagflation, the Fed's going to have to make a choice to either, like you said, pivot or keep things tight until the inflation part goes away, essentially, and then really crush the economy. It seems like both directions are terrible.
Yeah, well, you have to realize what would happen if the Fed did that. Like, what would happen if the Fed said, you know what, we got to break the back of inflation.
Yeah.
We're Volcker. We're going medieval on inflation, and you guys got to just deal with it. I mean, think about what would happen. Okay, so first of all, yes, the stock market would crash.
Yeah.
The real estate market would crash. The bond market would crash.
Yeah.
We would have a far worse financial crisis than we had in 2008 because there's much more debt.
Right.
All these banks that were too big to fail, that we bailed out, they're all going to fail again, except now they're way bigger, right? And no bailouts. Because when we had the financial crisis of 2008, the Fed was there to bail everybody out. We had TARP, we had all these programs. We wouldn't have any of those programs. So we'd have a worse crisis, but with no bailout for anybody, which means, it's so much worse. But it doesn't end there. You see, because in 2008, bank stocks went down, right? But the depositors didn't lose any money. If you had your money in the bank, you didn't lose any money.
Sure.
If the Fed actually fights inflation, depositors are going to lose money. The banks are going to fail, and there's no money there. There's no money in the FDIC. Now, the only way their money is in there is if the Fed prints it. But if the Fed says, no, we're not in that business anymore, we're not in the money printing business, well, then the FDIC is out of business. And so you have a bank account, you lost your money. That's what's going to happen. Now, the U.S. government is going to be stuck, right? Because the Fed's going to be jacking up interest rates. We got a $30 trillion debt that's going to be exploding in this massive recession. We owe a ton of money. We can't pay it. The Fed's not monetizing the debt anymore, so the government has to default. The U.S. government has to tell people who own Treasury bonds, you're not getting your interest payments. And when your bond matures, we can't pay you what we owe. We don't have the money. Or, alternatively, they could say, we're going to pay our debts, so we have to raise taxes on the middle class. We know that you've been wiped out, your stock portfolio's crashed, you've lost all your home equity, but we're going to double your income tax. Hey, we're going to triple your income tax. We're going to come up with a national sales tax because the Chinese want their money and we're good for our debts. So we got to pay the interest on our bonds, so everybody's got to have a big tax hike. Oh, and by the way, if you were expecting Social Security, sorry, we don't have the money. We got to pay interest on our bonds. We can't give you a Social Security check. We can't pay for your Medicare. I mean, these are the things, these are the tough political choices that we haven't made that we're going to have to make in a crisis environment where they're much more difficult. I mean, maybe we have to give everybody a haircut. Maybe we tell the bondholders, okay, we're going to pay you something. We'll pay you 70 cents on the dollar, 50 cents on the dollar. Social Security recipients, we're going to cut it in half, or we're going to means test it. Unless you're dirt poor, you don't get any Social Security. I mean, I don't know. But these are the choices that we're going to have to make if the Fed decides it's going to fight inflation. Now, I just don't see that happening. I don't see the Federal Reserve having the ability to stand up to the political pressure to prevent that. I just see that, you know what, we don't want default, we don't want to, we're just going to print money. We're just going to have higher inflation. That's the lesser of the two evils. That's what they're going to think. I think they're going to be wrong. It's going to end up being worse because it could end up being hyperinflation. And that's worse than any of that. I mean, because then nobody gets anything. Hyperinflation, everybody's wiped out. The bondholders are wiped out. Pensioners are wiped out. Yes, everybody gets their Treasury money back, but it buys nothing. Everybody on Social Security gets a Social Security check, and then they can rip it up, and they can use it to line their birdcage because it's not going to buy you anything.
So, I mean, it sounds like, I mean, that does sound like a devastating scenario. And I agree with you. I think politically and just the purpose of the Fed, they would do anything possible to avoid default and maintain the full faith and credit in the US dollar, which I know you're not the biggest fan of. But are you then suggesting that maybe the more likely scenario is they just say, you know what? We're just going to raise the inflation target temporarily to 3.5% or 4% or whatever. We'll raise rates a little bit, but we're just gonna see it through and just wait until maybe that technological deflation comes.
They may try that, but we're going to be so much higher than 3% that saying we're going to raise the target from 2 to 3 when we're at 10, I mean, you're not going to have any credibility there. And of course, the minute they raise it to 3. Well, now you know they're going to raise it to 4. I mean, you start going down that slippery slope, and the market doesn't trust you. And they're not going to trust the dollar. I mean, its days are numbered. I mean, we are very close to a major currency crisis. And I think, look, the Chinese know it. The Russians know it. I think a lot of people are preparing for it. That's why they're buying more gold. That's why they're doing the deals that they're doing. They're moving away from the dollar, wherever they can. And they're trying to divest and trying to wean themselves off this system because they know it's going to come to an end.
Wow.
The only ones that don't know it are the Americans. I mean, we're still living as if we're going to be able to do this forever because America, we owe our standard of living to the U.S. dollar being the reserve currency. I mean, I mentioned earlier in this interview that we're running $1 trillion a year merchandise trade deficit. That means we're getting $1 trillion worth of stuff that we haven't paid for. I mean, we paid for it, but all we did is print money. We didn't have to make anything. We just printed up a bunch of money, and we got $1 trillion worth of real stuff. I mean, how did the world make that stuff? They needed factories. They needed workers at those factories. They needed energy, right? Real resources were expended to make this stuff, and we got it. And what did we give them? We just generated numbers on a computer. Here you go. Here's $1 trillion. We just concocted it out of thin air. Thank you very much for $1 trillion worth of stuff. Well, when the dollar tanks and it's no longer really accepted as a reserve currency, we can't do that anymore. I mean, think about how bad the supply shortage would have been in 2021 if that $1 trillion worth of stuff wasn't there. Where would prices be if we didn't have all those goods that foreigners basically gave us for nothing? So we have a date with destiny here. It's going to be a very rude awakening when we realize just how poor we are. because we've been living on credit. We don't know that, but we're going to find out the hard way.
So I think the last topic then might be crypto as an inflation hedge. Your thoughts?
Well, I just don't think it's an inflation hedge because, what makes something an inflation hedge, right? Well, inflation makes prices go up, right? And it makes the value of paper money go down, right? So when somebody wants an inflation hedge, I got to get out of my paper because the things that I want to buy are going to get more expensive. And if I just hold this paper, my purchasing power is going away. So I said earlier, one of the things you could do is just start buying this stuff that you're going to need in the future and buy it right now, right? I'm not going to wait to buy stuff. I'm just going to buy it now, and that's a way to hedge inflation. Well, that works to an extent. I said we got a lot of stuff. My wife, we stockpile stuff. Every closet I open up, it's full of stuff, right? But there's only so much stuff. I mean, I can't put millions of dollars of stuff in my closets. Right? And stuff, even I said batteries. I mean, batteries have a shelf life. I mean, they're not going to last forever. There's a lot of things you buy them, if you don't use them in a couple of years, they're no good, right? Gold doesn't have a shelf life. I can buy an ounce of gold and put it in my closet, and it's never going to go bad. I could, give it to my children, who can give it to their children. But gold's also a commodity. People need it. Jewelers need gold to make jewelry. Computer chip manufacturers need gold in their chips, right? They just sent this big telescope into space. They needed gold to coat the mirrors, right? There's all these industries that need gold. Gold packs a lot of value in a small space. So instead of buying a bunch of oil, buying a bunch of wheat, right, stocking up on these things that are bulky and have a limited life, I can stock up on gold. Because in the future, I can trade my gold for the stuff that I need in the future. So I can use my gold to buy something because somebody is going to need my gold in their business. And the price of gold will go up along with the price of everything else. So I can hedge inflation by owning something real. Now, Bitcoin doesn't have real value like gold. Nobody uses Bitcoin in anything, right? It's not used to make anything. People just trade it, right? You use it, I can give it to somebody, but the person who gets it can't do anything with it except give it to somebody else, right? You just pass it around like a hot potato. The reason they're trying to claim it's an inflation hedge is they say, well, it's got limited supply, which is true, but of course you have to ignore the 17,000 other cryptocurrencies that you could buy instead of Bitcoin, right? There's all these altcoins out there. But just accept on face value that Bitcoin is scarce, even though it's really not, because one Bitcoin is just an arbitrary unit of Satoshis, right? If I talked about Satoshis and I said, how many Satoshis are there? 2.1 quadrillion. You wouldn't really, they don't sound that scarce when you start talking about 2.1 trillion Satoshis. There's plenty of Satoshis to go around, right? Everybody can have hundreds of thousands of Satoshis. But there's only 21 million bundles of 100 million Satoshis, which they decided to call it Bitcoin. But yes, let's say there's a limited supply of Bitcoin, but you don't know what the demand is going to be. The demand could be zero. There is always going to be demand for gold. There's always been demand for gold because gold is used in the real world, right? Bitcoin has only been in demand for 11 or 12 years. Prior to that, it didn't exist. And why do people want Bitcoin? Well, the vast majority of people want Bitcoin because they think they're going to get rich if they buy it, because they think the price is going to go to the moon. But if Bitcoin crashes, and it's potentially already doing that, then the vast majority of the demand for Bitcoin is going to go away. Now, you're still going to have some people, these true believers, that are holding on, but at some point they're going to be forced to sell, whether they're on margin, they borrowed money, and they have to sell because there's margin call, or because they need food. I mean, there's a limit to how long you can hold your Bitcoin, before you need to sell it to buy food, right? And the higher the price of food goes and the lower the price of Bitcoin goes, the more Bitcoin you need to sell to buy your food. So inflation, a weak economy is going to force a lot of people to sell their Bitcoin, and there's not going to be anybody who wants to buy it. So there's no way it's an inflation hedge because you have no idea if there'll be any demand. Doesn't matter about supply. You can have one Bitcoin. If nobody wants it, it's worthless. Now, people can say, well, if nobody wants 1 ounce of gold, it's worthless. Well, everybody's going to want an ounce of gold, especially if the price goes down, because gold is used in real things. And the cheaper gold is, the more people want to buy it, because I can use it and I can substitute other metals and use gold instead, because gold is better. The reason that gold isn't used in a lot of places is because it's too expensive. People would use gold if it was cheaper, but it's too expensive, so they use something inferior to gold. But as gold goes down in price, more and more people start using it. So, people just don't understand the real difference. All these kids, again, who are buying Bitcoin and they think it's digital gold. It's nothing. It's fool's gold. They're just too foolish to understand that.
Do you think it would be fair, and this is just a thesis I had, to separate potentially blockchain technology from the underlying coins, to say that, hey, maybe we can use blockchain technology in our financial system to speed settlement or whatever?
Yeah, look, I'm not saying that there isn't the potential for blockchain technology to be used in various industries. It may even be used in money. We could certainly have money on a blockchain, just not these tokens. Bitcoin is not going to work. So blockchain could be very successful, 10, 20 years from now, and Bitcoin could be worthless.
Right.
A lot, you can still lose all your money in Bitcoin. And, a lot of people like to compare, like, Bitcoin is like a car, and, I'm still riding a horse. Well, when the automobile was invented, there were hundreds of automobile stocks that came out, and almost all of them went bankrupt. So a lot of people were right that the automobile changed the world, but they went bankrupt buying auto stocks because they overpaid and the stocks they bought went bankrupt. So it's possible that blockchain could be a very revolutionary development, but all the people that bought these cryptocurrencies could still lose all their money. Because at least the automobile companies were making cars. These crypto companies don't make anything. They just make more crypto. But the crypto itself doesn't have any value. So you have to marry blockchain to things that have actual value. You just can't create a token out of thin air and claim it has value just because you arbitrarily set a limit on the number of these worthless tokens you're going to create.
Wow. Well, Peter, this was really incredible, and I really appreciate your perspective. And anything else you want to add, or potentially anything you want to pitch?
Yeah, first of all, a lot of people, they hear me talk about all these bad things that are going to happen. And, I'm not happy that these bad things are going to happen. I wish they weren't going to happen. I wish there was something I could do to stop it, because I would. In fact, everything I've done in my career is meant to try to stop it. I've gone to Congress several times and testified. I would go more, but they won't invite me anymore. They stopped inviting me after my third time. And if you could watch the congressional testimonies on my YouTube channel, the second time. I went twice. They didn't, and then they stopped. But and the policies that I'm advocating are bad for my investment portfolio. I want the government to do the right thing. I'm investing because I believe they're going to do the wrong thing. So I'm out there advocating that the government do things that will hurt my portfolio but will help my country. But because I know they're not going to do that, I know they're going to pursue policies that will hurt my country. Since the only thing I can control is my investments and how I invest money for the clients, I'm at least going to position my clients to make money from these foolish policies. Right? I wish I could make money from smart policies, but they don't have smart policies. I'm not in charge of that.
Yeah.
And some people think, well, it's not patriotic to invest your money, in Asia or in Europe. Look, what's patriotic is protecting Americans from going broke. And if the way Americans avoid going broke is acquire assets in Europe or Asia, then that's what you got to do. Because some European or some Asian is selling us those assets and taking our dollars. Right? So I want Americans to have more wealth. The only way we're going to have more wealth is if we acquire it abroad. If we just keep our wealth here, we're going to lose it. So we got to accumulate wealth so that we have wealth, so that when everybody else is broke, we can make a difference in the world. We can bring our money home. We can use our wealth to help rebuild the nation. And I hope we have that opportunity. And because we're going to have to eventually do the right thing. And that is my hope. I know we won't do the right thing until we've run out of every other possibility. So we're going to do the wrong thing as long as we can. But when we can no longer do the wrong thing, when it's so bad that the only thing left is to do the right thing, hopefully that's what we do. And then we'll be in a very good position. Because if they never do the right thing, then we just become a totalitarian society. And then, God help us. I mean, then it's like you got to leave. You can't even stay here. And maybe my wealth won't help me if they just start confiscating it, right? I mean, you make a bunch of money and then the government just takes it from you. It's not fair. I mean, they might say, it's not fair that somebody profited from this, right? We want to punish the speculators, right? These greedy speculators are the reason you're having people like Peter Schiff made all this money. He's the reason that we had this collapse. He was betting against the dollar. He crashed the dollar. He is we got to take his money away from him. It's not fair. This kind of stuff could happen.
If you had to narrow down to your favorite 2 countries to buy stocks in both Europe and Asia, what would those 4 countries be? 2 in each.
Yeah, I don't know which are the favorite ones. I've always been partial to Switzerland and Europe. I mean, we don't have that many Swiss stocks in the portfolio right now. We have a couple. But I've always liked Switzerland as a European country. And in Asia, I've always liked Singapore.
Okay.
It's just like a real quality. And if you look at those countries too, I mean, they score very high on the index of economic freedom. And, they have low taxes and low regulations. And, they make stuff and they have sound economies and so that's the key. I mean, the key to prosperity is limiting government.
So Germany, too big government.
Yeah, I mean, look, and Singapore has big government in certain ways, but they have very small government in the ways that are important when it comes to the economy. Right? So maybe they have really really harsh penalties for spitting on the sidewalk, right? So in that way, it's that's pretty tough. But go open up a business in Singapore, right? See how easy it is, right? You're free to just open businesses, very inexpensive, not a lot of government, overseeing, how you're working your business. There's no minimum wage law there. There's not that many countries that are smart enough not to have a minimum wage. Yet the average wage in Singapore is way higher than it is here, and they don't have a law mandating any kind of minimum. It's just a free market bids up wages because they have a prosperous society because the government gets out of the way. And my point is we succeeded in America in limiting the size of government like no other country. And that's why we became wealthier than any other country, because we had the smallest government. We had the freest people. We don't have that anymore. That's what I'm hoping ultimately we can restore in this country. It's not going to happen until the aftermath of a crisis. But I'm also helping, and that's with my podcast, and people should listen to my podcast, and they should tell other people. I want more and more people to understand this, because when this next crisis happens, the government will blame it on capitalism, just like they blamed the 2008 financial crisis. Capitalism has nothing to do with this. If we had capitalism, we wouldn't have these problems. It's the failure to have capitalism. It's central government planning. It's the Federal Reserve. That's not capitalism. There's nothing capitalistic about the Federal Reserve. It is a socialist organization created by government to, price fix money and regulate the economy. That's not, free market. You don't have a central bank, and to try to say, capitalism doesn't work, and you point to the Fed. Of course, the Fed is socialism. So I want people to understand this train wreck is going to happen. And the people who are out there telling you everything is great, they're gonna spoon feed you some more lies when it turns out it's not great. And what they said about me, after I was out there predicting the 2008 financial crisis, and then it finally happened. They're like, Peter Schiff, he's just a stop clock. He's been saying this for years. Yeah, it was true for years. I was warning people in advance. I knew what was going to happen. I didn't know how long it was going to take to happen. I just knew it was going to happen. And they were like, well, nobody could have really seen this coming. Nobody knew we were going to have this financial crisis. Nobody saw this housing bubble. This was a 100-year flood. That was all a bunch of nonsense. They're going to say the same thing again. And they'll say, Peter Schiff, yes. Well, of course, he's a stop clock. He's finally right again. I've been right the whole time. They're the ones that have been wrong. Their clocks are stopped. They think everything is great. They don't understand it's just an illusion created by the Fed. They can't see the bubble because they've been trapped inside it for so long. I understand it perfectly. I just don't know how long it's going to take before every bubble they blow pops. I just know that it's going to happen. And so when this happens again, I want more people out there to understand why it happened. And if we don't want it to happen again, if we want to do the right thing, we can't keep listening to the same people that created the problem, right? Because they don't know how to solve it. Because again, they're going to try to print their way out of a problem that they created by printing money, right? Again, we're not going to be able to drink ourselves sober. We're going to have to do something completely different.
Wow. Wow. All right. Well, how do people reach out to you, Peter?
Well, listen to my podcast at schiffradio.com or on my YouTube channel. I do 2 or 3 podcasts a week. So make a habit of listening. Again, as I said, tell your friends. You can follow me on Facebook or Twitter is where I think my biggest platform. I've got now maybe about 650,000 Twitter followers. So I do a lot of tweeting. I'm getting close to 500,000 YouTube subscribers. So you can subscribe to YouTube and listen to my podcast. I'm even on Instagram now. That's kind of new. I just started that like a year or so ago. But just follow me on social media and then get more people to follow me. You know, it's important that my voice get out there, and I appreciate your helping me. You've got a good audience and helping me reach that audience. If you're interested in hiring me to manage your money, right, and help get it out of harm's way and take advantage of the opportunities all around the world to buy these lower priced value stocks that pay good dividends that I think will thrive in an inflationary, stagflationary environment where people are losing a lot of money, especially adjusted for inflation in the U.S. the way they did in the 70s, and they're going to do even worse in this decade. Contact me at Euro Pacific Asset Management. The website is epacfunds.com, or you can get a hold of me through the broker-dealer in the U.S., europac.com, EUROPAC.com. I got reps down there that can get you into my strategies. We have reps here in Puerto Rico who can get you directly into my asset management company. Also, you'll notice above my shoulder is the logo for Schiff Gold. As I said earlier, gold does very well in an inflationary environment, gold and silver. I expect gold and silver prices to move up dramatically. I think gold and silver should be owned instead of cash, not instead of investments. Gold is not an investment. It's a proxy for liquidity, for cash. It's money. It's a store of value. So you should have some of your wealth in cash, gold and silver, maybe 5 or 10%. The rest of it, I think, should be invested. Now, if we get to a point where a lot of my stocks are expensive and I want to sell and I can't find more value stocks to buy, then maybe we should have a higher allocation to gold. But right now, I think there's still a lot of relatively inexpensive stocks around the world that we can buy. And those stocks pay dividends, they have good earnings. That's why Warren Buffett has never been a fan of gold, because he looks at it as an investment and he says it's a poor investment. And I agree with him. It is a poor investment because it's not an investment. Stocks are an investment. Now, stocks can be a bad investment if you overpay. So I'd rather buy gold than overpay for stocks, because you're making a bad investment. I'd rather hold on to my gold until those overpriced stocks come down in price. And when they become a good investment, I'll use my gold to buy them. And Buffett would agree with that. I mean, he understands that gold is better money than dollar bills. I mean, Warren Buffett would much rather hold a pile of gold than a stack of dollar bills, right? But he'd rather invest in income-generating, dividend-paying companies, and so would I. The main difference between Buffett and I is I'm investing mostly internationally. He's investing mostly domestically. But I'm doing the same type of analysis, value investing, abroad that he's doing domestically. The problem is, the U.S. economy is in a lot more trouble, I think, than Warren Buffett understands. And maybe he understands it, but he's afraid to talk about it because he's afraid of, helping to speed up the process. He doesn't want to be blamed. There's a tendency to shoot the messenger if things go wrong, right? So he doesn't want to be the messenger. I've been shot with so many holes, at this point, because I've been delivering this message for so long. I don't care if I take any more shots.
Sure. That's a good point. Yeah. It's never fun to be perceived as bearish when you're trying to send a warning. So I hear you. Well, Peter, thank you. Appreciate it, and we'll see you again soon.
Yeah. See you again. Keep up the good work.
And Peter, hang out for just 1 second for everybody else. If you found this video helpful, consider sharing the video, and we will see you in the next one. Thanks again, and